Good evening, everyone, and welcome to the second quarter FY19 post-result conference call of Havells India Limited. Today we are represented in the management by Mr. Anil Rai Gupta, Chairman and Managing Director, Mr. Rajesh Kumar Gupta, Full-Time Director and Group CFO, and Mr. Rajiv Goel, Executive Director. I will hand over to the manager now. Over to you, sir.
Okay, thank you, Avneet. Good evening, everyone. First of all, apologies for shifting this today, but we came to know that tomorrow is a holiday in Bombay, and also our board meeting was at a later time today, so I'm sure you must have just received the information memorandum. So again, on the result side, we are quite encouraged with the growth verticals at Havells. Across all the verticals. There is still a certain base effect in growth, yet we believe that we are gaining brand traction and market share. Lloyd had a muted quarter owing to adverse seasons, Forex headwinds, and channel inventory. We expect the recovery over the next 6 months, especially in the next few months. We should be having our new plant for manufacturing air conditioners also ready. On the margins, the key influence is attributed to cables, as the last quarter margins were aided by inventory gains, while this quarter has suffered due to wild volatility in commodity prices. Overall, to summarize, I would say the demand scenario seems to be improving, and Havells is in a good position to derive maximum gains from the same. Avneet, we can now proceed to Q&A.
Okay, sir. Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may please press star, then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star, then 1. The first question is from the line of Srinidhi Karlekar from HSBC. Please go ahead.
Hi. Thanks for the opportunity and congratulations on good set of numbers. Sir, I have a few questions on the room AC manufacturing plant. First one, sir, are you on target for the Q4 commissioning of the plant? And more importantly, sir, would it be possible to comment on the extent of localization that you are aiming to bring in the first year of operation?
So I think the plant, we believe we're on track. The assembly should start in Q4. That's what we had highlighted. As far as localization is concerned, you are also aware that in AC, almost 30 to 40% still needs to be sort of imported. But our endeavor would be that the maximum would be produced either in-house or sourced locally. I think these things will evolve. So maybe another quarter or so, I think we'll be able to better answer this question.
Okay, and the last one again on the plant. Would it be possible in terms of ballpark how quick the ramp-up could be in terms of production, like in terms of how much of the plant FY20 production could be from your new plant? Just ballpark number, just to understand. This question is really in the context of this custom duties getting increased and Havells seems to be disproportionately affected. So in that context,
The first season, you are well aware of this industry, Srinidhi. The first season, I think, would still be assembled here and some partly locally sourced, partly maybe imported as well. We believe in the third quarter of which let's say from this October-December quarter onward, I think our localization will be significantly higher. So I think after 19-20, I think we should be sourcing 60 to 70% in-house.
Okay, sir. Thanks for answering my questions and all the very best, sir.
Thank you. The next question is from the line of Abhishek Puri from Deutsche Bank. Please go ahead.
Yeah, congratulations for good set of numbers. Sir, two things. First on this AC, the Lloyd's part of the business. So their capital employed has gone up versus the last quarterly numbers that have been disclosed. So could you tell us if the inventory has gone up in the system now and how big will be the inventory? And secondly, on the cables business, if you can give us the underlying volume growth numbers to us, sir.
So on the inventory side, you are aware that there has been a bit of slackness in the season. So the impact of working capital, what we see is also from the payment of creditors. It's not entirely attributed to the inventory. And on the overall level, we believe the inventory is pretty much the same what we planned last year, but it has been largely impacted by the seasonality and the bit of a slackness due to channel inventory as well as the low season.
Cable, and on the cable side, the volume growth is around 20% in this quarter.
Thank you. And join back in the queue, sir.
Thank you. The next question is from the line of Arnab Mitra from Credit Suisse. Please go ahead.
Yeah, hi. Congrats on a great set of numbers on the top line. First question was on the switchgear business. You've seen very high growth this quarter. This has been a segment which has been otherwise muted in the last few years. So is there any one-off attributable to this in terms of exports or something, or do you see this as a trend change in terms of faster growth in the switchgear business?
I would say there are a combination of factors. One, the exports, which is still a small part of the business, but it has shown improvement in this quarter. But the majority comes from, we also have industrial switchgear business where we see, increased government demand coming in because it's electrification projects. On the residential side, I would say that there is a slight improvement in the demand of trade and with completion of projects coming in. So overall there is, and the fourth aspect also is a little bit of a base effect over last year. Because, when we started out last year, GST, it started out at 28%, and initially there was some, I would say, inertia in the trade segment or the consumers to pick up material. So I would say a combination of factors, but over a period of time, I would say it is definitely better than what it used to be 1 or 2 years before, the demand scenario.
Okay, that's very helpful. Secondly, on the ECD business, you continue to grow very strongly here. Now, in your release, you've kind of attributed some of it to water purifiers and personal grooming, but my guess would be that these are still relatively small. So is it still that you're being able to grow the fans business extremely strongly to deliver this kind of a 40% growth?
Yeah, I think, as you rightly have understood that I think what we have said is water purifier and personal grooming has started, gaining a good traction amongst the consumers. So it gives us confidence that, our entry into new product categories, the aim that we have to be amongst the top players in the industry in a few years, that continues to remain strong, with our investment in people, distribution and brand and products. So I think that's showing a very positive result. But as you rightly said, these are still very, very small part of the overall consumer durable business as well. So fans being the largest part of the business has to grow significantly to give this kind of a growth. So fans has done very well, water heaters has done well, appliances has come back on track in a big way. And of course, all these things put together has given us a decent growth. And of course, as I said, it's a little bit of a base effect as well.
Right, and if I could just squeeze in one on margins, you've mentioned input cost inflation, and so is this margin pressure in cables, not only in cables but in general in the business, overall in some of the divisions, does it look more transient that there's a lag between taking price and input cost, or should we see this as a year when margin expansion is going to be actually difficult given the input cost headwinds?
Yeah, I would say this particular quarter is mainly impacted by cables and wires. But generally speaking, when the commodity prices are on a high, it is difficult to expand margins. But at least, we've seen our ability to maintain margins in all the other businesses. Cables and wires was a particular quarter. But we've been able to maintain margins in all our businesses.
Okay, thanks so much, and that's from my side.
Thank you. The next question is from the line of Sonali Salgaonkar from Jefferies. Please go ahead.
Sir, good evening. Congratulations on a great set of numbers. So my first question is, would you be able to approximately quantify the inventory loss because of copper that we have had in cables and wires this quarter?
Inventory loss. So there is no inventory loss. There is a time lag between the passing of the prices And suddenly when there is huge fluctuations, there is, it can result to correction happens and over a period of time. If we look at a longer period, then it evens out. But this particular quarter, there has been a loss. So, generally speaking, our cable and wire margins put together have been in the range of 15 to 17%. This particular quarter have come down to 14%. So you can do a rough math and see how big the impact would have been.
Sure. So we can we assume the steady state to be 15 to 17% and reverting back to the steady state over the coming quarters?
Yeah, in the next couple of quarters, it should come back to those levels.
Sure. So my second question is on the demand scenario currently. I mean, considering that we have started with the festive season, what kind of demand pickup? Are you seeing a demand pickup, especially in the durables and appliances side?
Yeah, so, this season has started off well, and I think this year Diwali has been a bit late. It's in the middle of November as compared to October last year. But at least we are seeing some, early trends, and things should be quite better this year.
Sure. So that's it from my side. I'll join back in the queue.
Thank you. The next question is from the line of Kartik Mehta from IDFC Mutual Fund. Please go ahead.
Good evening, sir. Thanks for the opportunity. Sir, I have a couple of questions on the wires and cables and switchgear segment. If you can just highlight what is the mix between industrial and residential in the switchgear? So,
as we've always maintained, primarily our business is around 70% residential and 30% industrial. So that is the breakup even now.
Okay, but you said that the industrial picking up, so I thought it should have gone up. Okay.
Yeah, so, it's maybe 1 or 2%, but overall...
okay.
Yeah.
And how much would be pure B2B business? Because I understand we have invested into B2B team and we are started chasing this new vertical aggressively. And what is the contribution of the B2B in total wires and cables as well as switchgear?
So wires and cables is, we have two businesses. One is purely industrial in nature. The other is completely domestic. So I think B2B, we have to see it cutting across all product categories and not business or business. And there is so we have two aspects to B2B. One which goes into industrial kind of customers and one which goes into residential customers. And all, because there is a more focus on these separate teams now, so we are seeing a faster than, market increase in these segments because these are still very small for us. So definitely their share is increasing in the overall business, but it is still, I would say, a very small part of the overall business.
Okay, so I was probably wondering that if the B2B pie is growing faster than the otherwise, and hence...
In general, yes, it is growing faster, but it doesn't really affect the overall growth in a big way.
No, so it would have some impact on the margin given the product mix?
No. You see, the B2B doesn't change the product mix. You see, for instance, even residential segment we said switchgear could come through the B2B.
Margin mix would be slightly lower in a B2B versus your...
No, not necessarily. No. B2B doesn't mean you sell at a lower price.
Okay. And
so your attendant costs are also much lower, na? You see, when you are doing a distribution business, you also have to pay for the distribution cost. In a B2B, those costs do not exist. So net, they do not have a very drastically different profile.
Okay. And so lastly, on a margin front, I could understand that you mentioned that there was a time lag in terms of passing on the prices in the wires and cables this year, in this quarter particularly. So eventually you would do the readjustment of the pricing as per the input cost. So outlook on the margins, if you can mention the 12% OPM this quarter, where do you look at from the 1 year perspective?
No, we have said the current OPM, if you see on cables wires, is 14%. I think we have highlighted it generally hovers around between 15 to 17, and that's what we believe we should get back to in the next few quarters.
So the blended margin should be above 13% for the rest of the year?
That I think you'll have to calculate depending on the growth aspect, growth for various businesses. So it all depends upon the product mix, the growth in each segment. So we can't really commit to a certain number, 13% or 14%. Okay.
All right. Thank you, sir.
Thank you.
Thank you. The next question is from the line of Achal Lohade from JM Financial. Please go ahead.
Yeah, thank you, sir. Congratulations for good numbers. I just wanted to check, if I look at the A&P spending, it seems to have gone up quite meaningfully in the quarter, especially with respect to Havells A&P, which is up 66%, almost 60 basis points YY. Is that also a reason for the margin, slight margin compression, so to say? And how do you see the A&P from a year-long perspective? Will it be similar percentage of last year, or you think there could be increase? Specifically for Havells.
I would say that, A&P in Havells is about 3% if you look at this quarter, and this will continue to remain like this. Last year it was 2.3%, which was a special quarter because, last year we had purposely cut down A&P during the GFC transition period because, we were also not very sure of the demand side. So, otherwise, generally our levels have been around 3%.
Right. And the second question I had was, if I look at the capital employed for the ECD business, it has increased QOQ from 170 crores to 275 crores. If you could help us understand the reasoning, is it largely to do with the seasonality? Because we don't see that happen in the last year.
Yeah, it is because of the, as we said, this is the build-up of the Diwali season. Diwali was earlier last year, so a lot of sales for this season had happened in the second quarter as well. It's a build-up of inventory for the Diwali season as well as the upcoming winter season for the water heaters and some, heating products of the appliances. So it's a build-up of that. I think in number of days, it's not really a, major increase.
Got it. Great, sir. Thank you for answering questions, sir. I'll come back in the queue. Thank you.
Thank you. The next question is from the line of Pulkit Patni from Goldman Sachs. Please go ahead.
So thanks a lot for taking my question. So my first question is on Lloyd. It'll be good if you could just discuss the strategy because what we were expecting was while there is inventory in the channel, we were not expecting the margins to actually get impacted. So if you could just talk about how should one look at Lloyd for the second half of the year in terms of both our margin trajectory and in terms of our expectation of growth for that business. That's my question number one.
Yeah, so if you see the margins, we said there are Forex, and definitely I think in this mute environment, we have been conscious of what we pass on, but the industry also has not responded on the same. So the costs have gone up because of the Forex headwinds, while the pricing is not reflecting that. I think as we have put it in the commentary as well, in the next 6 months, we believe the situation should improve and we should be able to pass it on. And the growth, I think we continue to be, I think, fairly sanguine about the growth. There could be a one quarter here and there where the challenges could be there. But overall, I think this industry looks very robust in terms of the demand pattern. And I think in terms of the brand, we are gaining traction. We are opening new channels. There is a wider acceptance of Lloyd as part of Havells. So overall, I think trajectory looks good, but probably can't be commented on a every quarter basis.
Sure, sir. Sir, and on lighting and fixtures, if I take out the EESL business, the growth has been reasonably good. As I look at the second half, how does the EESL business look there? Or should we expect that there's not going to be any meaningful contribution in the second half from that business as well?
So, yeah, I think you should assume that there will not be any meaningful contribution on the EESL front. But on the lighting side, we are quite, positive. Not only just in value and volume growth, but also the fact that our recognition as a top technology player in lighting, that's increasing day by day with a lot of focus on newer technologies like the RGB lighting, monument lighting, facade lighting. So our professional luminaires, with our focus on B2B, we have segregated teams which contribute, not only look at various different product segments, but also different kinds of customer segments. So that's given a lot of focus. So our entire, customer profile of lighting is changing on the professional side. So of course, on the consumer side, we are going deeper and deeper into, distribution. So I think we are quite positive about lighting, and there we have a huge scope to improve our perception in the minds of the consumers.
And the pricing also is holding up in the lighting segment generally?
Generally, there is a big price erosion which has been happening in the lighting over the last few years, and that's continuing to happen. In fact, if you really see, our volume growth is more than 30% in lighting, whereas the value growth is around 18%. And despite having that like that, we are still holding up the margin. So overall, we are quite satisfied with the strategy that we've been able to deploy in the lighting business.
Sure. Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in this conference call, please limit your questions to 2 per participant. If you have any further questions, you may come back for a follow-up. The next question is from the line of Naveen Trivedi from HDFC Securities. Please go ahead.
Yeah, hi, good evening, everyone. So my first question is on the lighting side. Just want to know the margin profile which has improved despite the weak revenue growth. Can we expect that ex-EESL the margin trajectory will continue to show expansion?
I would say that, it's ranging between 27 to 30%. It's a similar range that we can expect.
And like you said that the EESL thing will not be there in FY19. So can we expect that going ahead also that kind of business will not be no more there for us?
We've always looked at this business opportunistically. We've always maintained that we want to look at decent margin business where technology is understood by the consumer. So I don't see that we can really comment upon that unless and until some new tenders come up, which where our product as well as pricing is respected. So we'll have to look at it separately. Lighting business, which is for the general consumers, have to be looked at differently.
Fair point. And my last question is on any one-off in the other expenses side, like considering the growth which we have reported in the top line, other expenses are quite muted. So any one-off in the last year, if that would be the case?
No, not really.
Okay. Thank you so much, and all the best to you.
Thank you. The next question is from the line of Ashish Jain from Morgan Stanley. Please go ahead.
Hello. Hello.
Yes.
Yeah. Hi, sir. Good evening, Mike. Sir, my question is again on the cables and wires margin. Now, if we have not taken any inventory write down, what has really driven this margin contraction? Because copper prices, if my numbers are right, were down sequentially this quarter. So which shouldn't have hurt us on our pricing front. So which ideally should have taken some inventory write down. So I just want to understand what drove this copper margin, the cable and wire margin contraction.
No, margin, as we said, had this not happened, it should have been in line with our average, which is around 15 to 17%. So I think we should have been maybe a couple of percentage points better.
Yeah, Rajesh, I understand that, but I just trying to think what actually happened this quarter for the cable and wire margins to take such a big beating if there was no inventory write down.
So let's say that, if you look at the cables margins are not that impacted by the pricing of copper. It's the domestic wire business. Domestic wire business, you're rightly saying that, it not only came down, but it has suddenly moved up, at the end of this quarter as well. So, so there has been so much fluctuation that generally there is a time lag in passing it on to the consumer. And when it comes down, you have to immediately pass it on, and some inventory write-downs also happen. But that all goes into the COGS of the business. That's why the domestic wires business, which is the more stable business in terms of margins, have actually been impacted in this quarter. That's why we are very confident that it can come back.
Okay, but have we now taken any price hike to offset, the spurt in price which has happened towards the end of the quarter or not yet?
That is a continuous process. Within the next 10 to 15 days of any major commodity price increase or decrease, it gets passed on.
Okay, got it. Thank you so much.
Thank you. The next question is from the line of Harshit Kapadia from Elara Capital. Please go ahead.
Sir, congratulations for a good set of numbers. Just wanted to dwell a bit on the cables and wire segments. So can you split in terms of revenue, how has been in this quarter for cables and wires? And since you have said that the residential segment is where you are seeing a pickup in terms of real estate. Can we expect the wire segment to grow much higher than what we have seen in the first 2 quarters?
So, in fact, I would say it's around 50-50 at the present moment. The growth has been higher in the industrial side in this particular quarter. But also it is more because of the base effect, because last year, in underground cables, suddenly there was I would say, a big inertia in terms of contractors and buyers buying, because underground cables also came out at 28% GSP. So second quarter was quite a muted quarter. But otherwise, overall, it's about 50-50.
Okay. And so which are the sectors within cable that you are seeing growth, if you can highlight?
Largely we are seeing in infrastructure related, because a lot of projects are getting on stream. I think government focus also is helping in that. So largely it's infrastructure driven, and yes, some real estate project where the developers are focusing on completion. So there also we are seeing the traction.
Okay. Thank you for...
Thank you. The next question is from the line of Niket Shah from Motilal Oswal. Please go ahead.
Yeah, thanks for the opportunity. 2 questions. First is, sir, just wanted to know, given the fact that Voltas Beko has also recently launched and it will be fairly aggressive launch that they're going to do. So how do you get more shelf space within the tier 1 markets, within the AC as well as the non-AC category as far as Lloyd is concerned? Does it mean that we also have to give higher margins within these distribution channels?
I think one of the biggest benefits of Lloyd or Havells coming into Lloyd has been the expansion of Lloyd into many new channels which hitherto not there. So Lloyd, as we have explained earlier as well, was more of a distribution brand going into retail outlets, but now it's present all across categories of modern format retail, regional retail. So I feel that our shelf space has increased quite a bit in the last 1 year. It's just and it's growing every day. So I don't see that as a major challenge, with especially with Lloyd coming in as a part of Havells. There's a big confidence booster to the trade as well, and hence I think we have to look at it from that point of view. Definitely, new competition will continue to be there, and it has been there in the past and will continue to be there.
But on the margin side, as far as distributor is concerned, we're broadly in line with the other peers, what they give to them.
Of course, yes.
Okay. And the second question was on the Lloyd brand itself within the AC category. You're very strong in tier 2, tier 3 markets. Obviously, your endeavor was to get into tier 1 markets in a big way. How do you change the brand perception of Lloyd? You're not supposed to be known as a premium brand as such. So that was one question, and similar question to that was, what is now the pricing gap between you, between a Lloyd AC versus say a Voltas or any other competitor AC on a like-to-like basis?
I think it may be better for us not to say this. It might be better if you guys are so adept at doing channel checks. Maybe better off if you do a channel check on that. There has been huge perception improvement. In case of Lloyd, we've spent heavily on brand building, our improvement of perception in the trade as well, in the minds of the consumers as well, and that's reflecting in the pricing as well. So it's not that our profit margins are increasing, but we are constantly giving more and more product features so that the consumer perception is, as well as the service, so the consumer perception keeps improving. So if we have gained a lot in the last 1.5 years, which constantly is being proven by the research that we keep doing, is the improvement in the perception in the minds of the consumers for Lloyd.
Got it. Thank you so much, and best of luck.
Thank you. The next question is from the line of Abhineet Anand from SBI Cap Securities. Please go ahead.
Yeah, thanks for the opportunity. So just wanted to know, in Lloyd, do we have any Forex impact during the quarter? And if yes, what was that number, sir?
So, Abhineet, this was largely in our COGS because whatever we received, this has become part of the inventory cost. So I think it has been around, let's say, 5 to 6%. The cost of the inventory has gone up because of that. And I think this ultimately, as we said, will get adjusted over the next 6 months.
Okay, so 5 to 6% of the sales, right?
No, I'm saying the inventory cost has gone up because the dollar has appreciated by that much. in the quarter.
Okay. So the COGS, if I adjust by 5 to 6%, that would be the number.
No. I don't think that's how you can do it. But largely, it is fair to say that there have been a substantial forex fluctuation on the cost part. But I don't think you can just compute it by that. And maybe we can then take it offline if you require.
Okay. Thanks a lot. That was my question.
Thank you. The next question is from the line of Nayan Parak from IIFL. Please go ahead.
Yes, could you share your outlook on the fans market, specifically given the high growth that we have seen in the quarter? Has the market also grown in line, or we have significantly gained market share during the current quarter? And what is the outlook going forward?
I believe we believe that we've gained market share. That right now we don't have any research results, but it's more from the channel discussions that we've had. So we seem to have gained market share. And I think as we've been saying in the past also, there's a lot of focus on expanding models which keep beholding the customer perception for the Havells brand. So I guess our focus on product, brand, and distribution has definitely helped us. And despite us having the largest market share for premium fans, I think we've gained market share there as well.
Okay. And regarding coming back to the lighting segment, you had indicated the focus has been more on increasing the professional segment. But we are also seeing significant price dilution. Do you feel that there are margin headwinds in the current quarter because of that? Or because of our strategy of changing product mix, we can offset that?
So as I said earlier, our strategy on lighting has been quite healthy. We've been improving the perception based on product and technology. So in fact, we have been improving margins. So I don't see any reason why we should be worried about the price erosion in this. We've grown 18% in this business. Our volume growth has been more than 30%, and our margins have improved. So we are quite hopeful about this business.
Okay. And just a data point question, sir. What would be the EESL sales for FY18 for the full year?
Around 130 crore.
Okay, sir. Thank you.
Thank you. The next question is from the line of Akshay Thakkar from Fidelity. Please go ahead.
Hi guys, congratulations on a great set of numbers overall. My question was not to do with the quarter. It was just on a slightly longer horizon. If we look at employee cost to sales, it's gone from roughly 4% to 8% over 7-8 years. And we understand where this is coming from. You are building teams, you are getting into newer products. Lloyds would have added to that. But just generally, when you're looking at how employee costs are or your manpower strength is there scope for this to go up more, or you are satisfied with where they are? Because over a period of time, that could add to margins, right?
Yeah, so I think, as you rightly said, that over the last few years, we've been investing heavily on building capabilities in the organization. This is again to build a long-term sustainable business for all product categories. And of course, new product categories are constantly being added, so that comes with more of an investment. So I feel that this is a healthy level that we can continue that in the future. So over a period of time, you'll see this being the normal level.
Okay, great. One other question, just when you're talking about getting a lot of sourcing for Lloyds, etc., in-house, what does that imply in terms of Capex for the company over the next 2 or 3 years? Thank you.
So this year overall, we've grown, our overall Capex will be about 500 crores, out of which 325 crores is on the Lloyd plant. But once this plant comes on stream, I think overall we will be in the range of 200-250 crores overall every year.
Okay, thank you.
Thank you. The next question is from the line of Ankit Jain from Mirae Asset. Please go ahead.
Thanks for the opportunity. Sir, just wanted to understand, does this recent liquidity squeeze by NBFCs and all, are you seeing any sort of impact on the channel financing which you do avail to the distribution partner?
Not really. We haven't seen any significant impact of it. Actually, we are not dealing for NBFC. We have got very large banks who are supporting this. We have no exposure to NBFCs in our funding sources.
So even most of your distribution partners do avail channel financing from banks, or?
Yeah. So our channel financing plan is driven by the banks. And we see, if you're asking the consumer channel financing or consumer financing, it's largely in No, channel partner, whatever we do is with the banks only.
Okay, sure. Okay, thanks.
Thank you. The next question is from the line of Charanjit Singh from DSP Mutual Fund. Please go ahead.
Hello, sir. Thanks for the opportunity. Sir, you have highlighted about this professional lighting space. If you can give us some more color in terms of, who are the kind of customers, or, is it tender-based market, and who are we competing with in this market, and how is the margin profile in professional lighting?
There is a lot of color in professional lighting. So, professional lighting is almost, I would say, 40% of our business, and we've been in this business for the last 15 years. So when you are in lighting, you want to be both in professional as well as consumers. Some companies choose to be more in consumers, but right from the beginning when we entered lighting, we've been very focused on professional lighting as a business. Initially, because of the strength of the company, we started more on the government side and the infrastructure side. But over the last 2 or 3 years, we've built capabilities to focus on all customer segments, whether it's government, whether it is large offices, office complex, hotels, facade lighting. So you build capabilities, and we built capabilities in the last few years, and so you compete against the likes of Philips and Wipros and Bajaj and Comptons in this space. But we have dedicated teams separately for professional lighting. You asked about margin profile, and generally speaking, it's very similar to the consumer side of the business. So when you see a blended margin, we don't see much difference between consumer and as well as professional.
And sir, on the ECD space, we have been showing pretty strong growth over the last couple of quarters, and from Q3, Q4 onwards, that 400 crores run rate will start hitting. And do you see that the growth can be sustained in this segment, and which categories will drive the growth going forward?
So I think you can't really extrapolate the first quarter, second quarter into the third quarter, fourth quarter, because there was a big impact on GST in the consumer durable segment. If you see, the major impact in the first quarter came from the ECD segment last year. And even in this particular quarter, there was a base effect. So I think overall we are quite hopeful because of whatever we are doing in the ECD segment, new product categories, our expansion into channel, and more and more models coming into each product category. It's not that it will have a very different growth profile as compared to other businesses.
Thanks, sir. That's all from my side.
Thank you. The next question is from the line of Srinidhi Karlekar from HSBC. Please go ahead. Srinidhi Karlekar from HSBC. Please go ahead. Your line is unmuted.
Yeah, hi. Thanks for the opportunity once again. So my question is on the e-commerce strategy of Havells. So correct me if I'm wrong, but the general perception that we have is that the Havells is not so strong in the e-commerce channel compared to the way you are in the traditional channel. And with Lloyd now and having a significant appliances exposure, these are categories are something where e-commerce channel can have a significant impact. So in that context, I wanted to understand how do you see this channel, and how do you plan to improve your presence in that channel, sir?
See, as far as channel strategy is concerned, we believe in omnipresence, and this is something which has started coming in the last 2 or 3 years for Havells. Yes, traditionally we were more focused on the traditional offline channel, but in the last 3 years we've invested heavily into building teams which focus on all kinds of channels, whether it is modern formats, regional retail, online. Our strategy has also been that, we are a very channel-friendly organization in terms of the fact that we look at their long-term sustainable business with the company rather than very short-term measures. And we have always refrained from any channel, whether it is online or any other channel, which focuses on a very fast growth and, undercutting the other channel as well. So I think our online strategy has been very prudent. Today we are present in all online platforms, but we do not give any preference to any channel. And hence, I would say this will be more of an organic growth rather than a very predatory kind of growth in any channel. So that's why you could say that, but we are growing every year very fast on the online channel, but still maintaining our overall channel philosophy in online channel as well.
Thanks for answering my question, sir.
Thank you. The next question is from the line of Latika Chopra from JP Morgan. Please go ahead.
Yeah, hi. My first question was, just a switchgear. Just coming back to the growth factors that you talked about. You mentioned that residential segment has seen slight improvement in demand. Is it in any way pointing out towards improvement in the housing cycle? And should that imply that though the growth rates in second half will normalize on a full year basis, the growth rates for this segment could move more favorably towards, mid-teens, low to mid-teens kind of a profile now?
Well, first of all, the first part of your question, yes, it is moving favorably. When we see 1 year or 2 years before, practically there was no new builds coming up. Today we can see some new builds coming up as well as, project closures are also happening. So there is definitely uptake in the demand in the residential sector. I think I would not give any numbers at this present moment. Let's see 1 or 2 more quarters how we, fare and how this thing, continues because, as I said, there are a lot of project closures. Hopefully the demand should continue to remain. Today, in the residential sector, we don't see an investor community coming into investing into buying houses. So it's basically, pure demand. So that hopefully should, given the demographics, this should sustain. But let's see over the next few quarters.
All right. My second question was on Lloyd. You mentioned that next 6 months one should see, improving trends, and there was, mention of expecting that the market will also take up prices. Is your price increase decision dependent on a lot on how the others take price increases, considering the push, the cost push for you will be higher on a relative basis? How are you thinking about it?
Yeah, I think pricing is a lot dependent upon, brand perception, how the channel perceives you, how the competition is behaving, as well as the cost of the product. So, all put together, it's very, I would say it's a formula which cannot really be explained on a phone call right away.
All right. And lastly, your cash reserves building out. Any thoughts on inorganic, strategy for you?
Well, I would say that companies always remain open on any inorganic opportunities. Today, we have quite our hands full both on Lloyd as well as on Havells organic growth. But we'll always remain positive to look at any new opportunities.
All right. Thank you.
Thank you. The next question is from the line of Nishit Jalan from Kotak Securities. Please go ahead.
So my question is on the lighting part, especially the EESL business. If I look at last year, the contribution margin in EESL was about 7%. Now, this year we have not seen any business in EESL. Do you think the pricing has come off so significantly that it's not making any sense to get into the EESL business? Or do you think the EESL business itself has kind of come down so significantly that there is no business in the market?
Yeah, we were in a very small part of the EESL business. So we were not in the commoditized business. We were more into streetlights business. And yes, the number of tenders which are coming out for streetlight has reduced over a period of time. Initially, there was a huge push. And then, in government tenders business, there's sometimes, it's so dependent upon the price that unless and until the product features are fully understood, it is, we try and refrain away from that. So, yes, at this point of time, it's a combination of both the demand being a bit less as compared to what it was a year ago, as well as pricing.
Okay. So my second question is on Lloyd. Now, since we are starting our own manufacturing facility, so apart from getting a better control over your product quality and all, it should give you some cost benefit as well. So what kind of margin benefit or what kind of reduction in cost you see because of start of the in-house manufacturing facility? Because your EBITDA margins right now in the Lloyd business are below the other peers in this industry.
Yeah, I think definitely the whole idea of putting up a plant was that we will see improvement in the margins. But this is something, which will develop over a period of time. We've always maintained that we need to look at Lloyd as a long-term play. We continue to hope that we will continue to improve margins every year in Lloyd, partly because of the brand perception and also because of our focus on manufacturing in-house. But this is again, as I said, has to be looked at over a longer period of time.
Okay, thank you, sir.
Thank you. The next question is from the line of Akshvora from Praj Financials. Please go ahead. Akshvora, your line is unmuted. Please go ahead with the question. Akshvora from Praj Financials, your line is unmuted. Please go ahead with the question. Please unmute the line from your side. As there's no response, we take the next question from the line of Kunal Seth from B&K Securities. Please go ahead.
Yeah, thank you, sir, for the opportunity. Sir, in lighting segment, you had mentioned that, we continue to see price erosion. So is this a natural price erosion we have seen because of increase in volumes, or is there some pricing action that we are seeing in the market from many of the competitors?
No, it's a cost-based decision. The LED cost going down.
Okay, so we have not seen any pricing action from any of the competitors, right?
And there is pricing action by everybody because the cost coming down.
That is, but not otherwise.
Not otherwise means?
Means, no significant, as in any price war that you are seeing in lighting from any of the competitors?
No. At least, again, lighting is in an industry where there are so many players, fragmented industry. At least where we compete.
No, what I meant was, sir, from the larger players.
Yeah, where we compete, it doesn't seem like a price war.
Okay. Sir, and my second question is, sir, in a presentation made by you last year, sir, increasing the contribution of B2B, was one of the strategies that we'll look at to, scale up in terms of growth. So in your commentary in the call, you said that B2B contribution remains similar to what is last year. So when can we see, B2B contribution going up significantly in the business, or will it be in the same range because the overall growth is also robust?
So I think overall growth, which has been robust, is also contributed by a higher share of B2B. But B2B is still a newer play for Havells in the sense that it is a focused activity now. So hence it is contributing a bit more. But all these factors put together, new channels, B2B, are giving the kind of growth that we are, witnessing. Otherwise, things would have been, like the industry. So we are definitely growing faster than the industry, which really indicates that our initiatives on, deeper penetration into semi-urban, rural, B2B focus, MFR focus, online focus, all these things are contributing overall.
Right. Sure. Thank you so much.
Thank you. Participants who would like to ask questions, please press star, then 1. Participants to ask a question, please press star, then 1. The next question is from the line of Pulkit Singhal from Motilal Oswal Asset Management. Please go ahead.
Yeah, hi. Thanks for taking my question. So, hello.
Yes.
Yeah, hi. Thanks for taking my question. So, just wanted to check with you on the distribution initiatives. If you can please elaborate, I mean, where are we currently, I mean, in terms of some numbers, and what is the kind of potential you see over the next 3 to 5 years in terms of distribution?
So I can't give you any numbers at this stage, but, I would say that in a market like India, there will always remain a huge potential to grow the distribution. And our entire focus is based there, how we go deeper through more and more retailers down the chain, through distribution, through expansion, through our Sampark scheme. So there is a huge focus going on. And I believe that it will continue to remain for many years.
Okay. Any way of figuring out, excluding the distribution expansion, what could have been the growth on a like-to-like basis?
Why go into all these things? Let's be happy with growth.
All right, sir. Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Abhineet Anand from SBI Cap Securities for closing comments.
Yeah, I would like to thank the management of Havells, which gave an opportunity to SBI Caps for this opportunity to host 2Q call. Thank you.
Thank you.
Thank you very much.